So we need to wrap this module up talking about some other property tax laws, obviously that affect real estate. Now, before we even address these laws, it's important to understand as real estate agents, we're not accountants. We're not the CPA for the clients. So should you ever be given advice or even suggestions in terms of some of these tax laws that we're getting ready to talk about? Absolutely not. But as a real estate professional, you need to have some understanding of how some of these tax laws affect real estate. Okay, that's number one. Number two, you need to know it for test purposes, if for nothing, if for no other reason. But the point I want to make, do not try to become your client's accountant. Do not try to tell them how much they'll save or what it'll cost them based on any of these tax laws. You need to refer them to their expert, their accountant, and let them give that advice. All right, so let's look at some of these tax laws. The first few we look at are actually some tax breaks. These are positives. This is an advantage to owning real estate. And we start with mortgage interest deductions. That's huge. Now, when you borrow money to buy a house, you're paying interest on that loan. And that's a lot of money you're paying. I mean, if you have a 30-year loan, and say you borrowed $200,000 to buy a house, by the time you pay it all off, you will have paid almost probably close to $400,000. Because of the interest. So, that's a lot of money right there. Well, the good news is because these laws, the interest is tax deductible. So in a way, you get that back at the end of the year. So how much is deductible? It says you can deduct interest on loans up to $1.1 million. Now that $1.1 million, that's the total. But you need to be able to break that out a little bit. And it says that the interest that we pay on the acquisition debt is up to $1 million. So now, first of all, what is acquisition debt? That's the debt that you actually incurred when you borrowed the money. So if you borrowed $200,000 to buy a house, then your acquisition debt is $200,000. But you can go up to $1 million and deduct the interest on the acquisition debt. But then it also says if you have any equity debt, like a home equity line of credit or home equity loan, you can actually borrow up to $100,000 and deduct the interest on that as well. So between the acquisition debt and the equity debt, that's where you get a total of $1.1 million. So that's a good thing for home ownership. Another tax break you get is the property tax deduction. Probably, I'm sure no one likes paying property taxes every year. I know I don't. But at least on the bright side, you get it back. Again, that is a tax deductible expense. So you can sort of get that back at the end of the year as well. Now this next law is also another tax break. But something we can't get real deep into this one right now. And obviously we're talking about this homestead exemption. And and the main reason is because how this works will vary in some cases greatly depending on the state you live in. So we can't really get into a lot of specifics here in the national portion that we're going through. Just because there's so many differences from one state to another. But obviously, when we get into the state-specific portion of this course, whatever state you're in, we will look at this again and get into the specifics of this exemption as it applies to your state. But just sort of let you know what it is. It really does a couple of things here. One, it's basically a huge discount for those that qualify for this exemption. it's a very significant discount on what they would have to pay in property taxes each year. I mean, to the point in some cases where some people may owe no property taxes. Again, just there's a lot of variables that kind of drive that, but at the end of the day, at the very least, there's a very significant discount on how much you would pay in property taxes. Now, who qualifies for this exemption? Again, varies from state to state, but you see some of the things that are very common areas of exemption here. The first two, I think most states recognize for sure. Those with disabilities. If you have 100% disability, you probably qualify for your state's homestead exemption. Senior citizens, older adults, probably qualify for this exemption. But these other ones, I think it's probably a state by state thing, but like veterans, law enforcement, first responders, and I'm sure there are other exemptions as well that some states might consider that would allow them to take advantage of this discount on property taxes. But I will tell you the other thing it will do, the homestead exemption, it protects you from creditors. So if you owe money, maybe you got a big credit card bill or something, they can't come take your house. Okay, so the homestead exemption will also protect you from creditors. So that's a good thing. But again, we'll talk more about specifics about this exemption when we get in the state-specific portion of the course. All right, so moving on. The next tax break, again, another positive, would be discount points. Well, first of all, what are discount points? It's prepaid interest. It's interest you would pay in advance. So in essence, when you buy a discount point, which again is prepaid interest, it lowers your interest rate. So in essence, it's a way to buy down your interest rate. If you don't like your interest rate at whatever the lender quotes you, potentially you could buy discount points and that would lower the interest rate. But two things you need to understand about this. Now, we'll be getting more in detail about this in the finance chapter, which is coming up a little bit later, because this really deals with financing. But two things you need to know, and that are memory items here. You can get questions on this. But first of all, how much does a discount point cost? And the answer is 1% of the loan amount. 1% of the loan amount. So obviously if you borrowed $200,000, 1 point would cost $2,000. That'd be 1%. So that's the cost. And if you had to buy 2 points, then obviously then that would be $4,000 and so forth. But then the next question is, how much will each point that I buy, how much will that lower my interest rate? And again, another memory item, but the answer is 1/8 of 1%. So that doesn't seem like much at all. But it will lower your interest rate by 1/8 of 1%. So if you wanted to lower your interest rate by, say, 1/4%, that means you'd have to buy 2 points. And again, if you borrowed $200,000, 2 points would cost you $4,000, right? And then, is it worth doing that? You have to get your calculator out and do the math. How many payments would you have to make at the lower rate to save enough interest to equal what it cost you, the $4,000 or whatever it cost you to get it down to that rate. So you'd have to figure out how long would have to make payments to reach the break-even point. And then obviously after that, now you're saving some money. But you'd have to do the math and figure out whether that's the best thing for you or not. But the last bullet you see here about these discount points, this is a big deal. It says discount points are deductible, but only by the buyer. Only the buyer can deduct discount points, regardless of who pays for these points. So, first of all, why are discount points even tax deductible? Because it's just interest, right? Discount points is just prepaid mortgage interest. Well, we already talked about that. Mortgage interest is tax deductible. And because discount points are considered prepaid mortgage interest, then it would be tax deductible. But why does it say but only for the buyer? The reason that matters is because, and I'm sure this is probably nationwide in most real estate markets, but I can't say that for sure. I don't work in every market. But I know in my market, it is not uncommon. In fact, it's probably more common that when a buyer makes an offer to the seller, they will include in the offer asking the seller to at least pay some portion, if not all, of their closing cost, of the buyer's closing cost. And I'm telling you, this is usually several $1,000s. And depending on the market, especially if you're in a buyer's market, the seller typically will agree to do that, just to get the house sold. Well, part of those closing costs might include discount points. So in essence, yes, you're buying discount points, but the seller is actually paying for it. And even if the seller pays for it, only the buyer can deduct it. So whether the buyer pays for it themselves or if the seller pays for it, only the buyer can deduct discount points. That's a big deal there. You need to understand that. So there's your tax breaks. Now, these next laws we're getting ready to look at, in some cases might not be all that good, but let's talk about them because they are what they are. And here we look at the capital gains tax. And the whole idea behind capital gains tax is if you sell your house for more than you paid for it, obviously you made money, you experienced a gain on the sale. Guess who's going to want some of it? You got it. The government. They're going to want some of that. Well, the IRS considers real estate to be a capital asset. So when you sell a capital asset, i.e. real estate, and you experience a gain, meaning you made money on the sale, then you will have to pay a capital gains tax on the sale of that real estate. So how does this capital gains tax work? How much taxes might somebody have to pay? Again, this is sort of where what I was talking about at the beginning of this little module. Don't try to give advice like this to your clients. Don't you try to tell them what their capital gain is going to be, because you're not the expert. Now, we are going to go over some of the basics of how this capital gains tax works, but I got to tell you, there's more to it than what we're going to get into. Again, because we're not accountants, so we're not going to get into the weeds. So that's why you don't need to be trying to give advice, but this will hopefully give you an idea of how this tax works. There's 4 terms you see here on this slide. Obviously, should be in your text as well. And let's make sure we understand what these terms are. The first thing you see there is the basis. The basis, that's kind of like your starting point. Your basis will be whatever you initially paid for the property when you bought it. So say, for example, again, you paid $200,000 for the house, then your basis is $200,000. That's what they're talking about there. But then it talks about the adjusted basis. And what they're saying here is, there are a couple of things you could do during the time you own the property that would actually increase your basis. Actually make it go up. And I will tell you, that's a good thing. You want your basis to go up, 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 and up. You want to keep it up, keep it high as you can legally. And there's only a couple things you're allowed to do to increase your basis. But you're going to see here in a minute why the higher your basis, the better off you're going to be come capital gains time. Okay. So how do we adjust our basis or make it go up? Well, two things. One, any closing costs you incurred when you bought the house. For example, if you had $5,000 in closing costs, then you can add that to your basis. So the $200,000 basis plus the $5,000 in closing costs, now your adjusted basis goes to $205,000. So any closing costs you incurred, you can add that to your basis. The only other thing you're allowed to add would be any capital improvements you make during the time that you own the property. Now, one thing you want to be careful of here, there is a difference between an improvement and a capital improvement. The IRS defines what can be considered a capital improvement. We're not going to get into that. Again, we're not accountants, so we're not going to go down that road. But just to give you an example, say I have a one bathroom house, and I want a second bathroom. So I decide to add another bathroom. Well, I will tell you, if you add square footage, you add living area, typically that would be considered a capital improvement. Again, you better talk to your professional before you try to do that yourself. But anyway, but say I spent $50,000 adding a new bathroom. Okay, then I can add that expense, because that's a capital improvement, to my basis. So now I'm up to $255,000. So, that's how this adjusted basis works, okay? You can add closing costs to your basis, and you can add capital improvements, the cost of those improvements to your basis. It's always a good thing. And by the way, if you're going to take or want credit for these capital improvements, you have to report this in your tax return in the year you did the work. So for those of you doing your own taxes and you don't understand how all this works, this could be costing you a lot of money at some point in the future. It could. So just be aware. If you did not report it in your tax return, that it's not going to affect your basis at all. Okay, not for tax purposes. All right, so once you know the adjusted basis, then we would have to know what our amount realized would be. Your amount realized, it would be the actual sales price, whatever you actually sold the property for, minus any expenses, closing costs, any kind of selling expenses you incurred in selling the house. That would include real estate commission. Any commissions you pay to a real estate agent. Those are selling expenses. So you would deduct whatever your expenses are to sell the property from the actual sales price, and then that is what we would consider the amount realized. And then to figure out what your gain was on the property, all you got to do is take that amount realized minus whatever your adjusted basis was, and then obviously that gives you your gain. And then whatever that gain is, that's what you owe taxes on. Okay. So let's look. Actually have an example here on how this capital gains would work, now that we kind of talked about it. But you remember our basis would be whatever the purchase price was. In this example is $100,000. But then we want to add to our adjusted basis, right? So in this example, we had $3,000 in closing cost, but we also had $25,000 in capital improvements. So we add those to our basis, and then we come up with an adjusted basis of $128,000. Okay, so that's how we get that number. But now we got to figure out, again, the amount realized. Remember, the amount realized would be whatever you sold the property for. In this case, it says $275,000. But what do we do with the sales price? Remember, we get to subtract any selling expenses we had In this case, it says there was $15,000. So that leaves us with an amount realized of $260,000. Now, again, to figure out what your gain was, remember you got to take this amount realized and subtract the adjusted basis. So our amount realized is $260,000. Our adjusted basis was $128,000. So we subtract that, and that leaves us with a capital gain of $132,000. So potentially that's what you would owe taxes on, $132,000. Y'all, hopefully you can see now why this adjusted basis is important. The higher it goes, the lower your gain would be, right? So the less taxes you would have to pay. So that's how the capital gains tax works. Now here's the good news about capital gains. Most people will probably never have to pay capital gains on their owner-occupied home. And here's why. Y'all would get, there's an exemption. Y'all, there are capital gains exemptions if it's your personal residence and you live there. Okay, and we'll talk more about qualifying, what the qualifications are in this for the exemption here in just a second. But right now, let's look, what is the exemption? What do I get if I qualify? Well, if you own the house yourself, you're the sole owner, you're the single homeowner, then it says you get a $250,000 capital gains exemption. Y'all, so as long as you didn't make more than $250,000 when you sold the property, you owe no capital gains tax. Now, if you're married, and assuming you are both on the title, you both own the property, y'all, it kind of depends on how you file your tax return as to what your exemption would be. Y'all, some married couples may file separate returns. Y'all, the husband files his tax return, the wife files her own tax return. If you do it that way, then both spouses, both the husband and the wife, will each get a $250,000 exemption apiece. Y'all, that's pretty good there. But probably most married couples will file a joint return, just one tax return with all their taxes included. If you do it that way, then you will get a $500,000 capital gain exemption. Y'all, that's a lot right there. Y'all, you make more than $500,000 by selling your house, or any house for that matter, you ought to help us out with some taxes, shouldn't you? Help us out. We need to help. But that's the exemption you would get. Now, how and what do you have to do to qualify for the exemption? Pretty easy. Y'all, again, it has to be your personal residence. Y'all, this does not work on investment property. But you have to have lived in the home. Obviously, you got to own the home for at least 2 years. And then you must live in the home for at least 2 out of the last 5 years. Y'all, that's not a big deal, I don't think, for most people. Y'all, I think most people, when they buy a home, they're going to keep it, stay there for at least 2 years. But as long as you own it for 2 years and live in it for 2 years, or at least 2 out of the last 5 years, then you qualify for this exemption. So that's why I say I think most people, when they go to sell their personal residence, y'all, they probably never pay any capital gains tax. But the last bullet here, it does say if you should sell your home and lose money, y'all, you had to sell it for less than you bought it for, then that's on you. Y'all, there is no deduction. You don't get to write that off for tax purposes. That's just going to be a loss, and hopefully you'll make a better investment next go round, because you're not going to get that back. Okay? All right, so that's capital gains. Now we've got 2 more laws that you need to understand, and both of these last 2 laws were put in place to help investors. Because y'all, we just talked about how owner-occupied properties are pretty much exempt. But what about investors? Because y'all, if I have a rental property, obviously I don't live there. It's rented out by a tenant, so I wouldn't qualify for the capital gains exemption. So Congress has passed a couple other laws, these next two that we're going to talk about, really geared towards helping investors when it comes to these capital gains taxes. I will also say, y'all, for both of these next two laws, if you decide to do either one of these or try to take advantage of either one of these, y'all, this is not something you can just do on your own. By law, you must hire an intermediary, y'all, somebody to handle the transaction on your behalf. It must be a qualified intermediary, y'all. Somebody, this isn't just a real estate agent. In fact, it's usually an attorney, but somebody that understands these laws and how to deal with it. So, if you don't have an intermediary, you're not going to be able to do this. Okay, you can't do it just on your own. All right, so the first one we talk about it is something called a 1031 tax deferred exchange. 1031 exchange. And I think it's easier to kind of understand this if I just give you maybe an example of how it might work. But what we're doing is kind of like I won't even get into that. Let's say I have 5 rental properties. And to make math easy, let's just say each property is worth $100,000 a piece. So obviously all combined, I got a total value of $500,000 between all 5 of them. And what my goal or objective here is I want to find somebody that has a house at the beach. I want a beach house. And I would like to find somebody that would be willing just to exchange properties. I'll give you all 5 of these rental properties for your one house at the beach. We're just exchanging properties. Well, then let's say I find somebody willing to do just that. They're willing to do this exchange. The problem is the house at the beach is, let's say it's worth $560,000. Well, that's not a fair exchange. It's not an even exchange because my property is only worth $500,000. The guy at the beach is worth $560,000. So the guy at the beach is probably going to say, well, yeah, I'd be willing to do the exchange, but not like this. You got to even up. You got to do something to even up this trade. I can't just lose $60,000 here. Well, then obviously I'm going to have to throw something in to even up the trade. Now, whatever you use to even up the trade is what we call boot. Now, I will tell you, and you're going to see here in a little while, you don't really want to be the person receiving the boot, but it has to happen. So what is the boot? Probably more times than not, it would just be cash. So maybe I would just give $60,000 cash, to even up the trade. But it doesn't have to be cash. It can be anything worth, in this case, $60,000. Maybe I got a motorhome that's worth $60,000. So I say I'll throw this in the deal to even up the trade. So we go ahead and make the exchange. Now, once this is all done, how much money actually ever came into my possession? How much money came into my hands or into my bank account? None, because we just exchanged properties. But what about the guy at the beach? How much money actually came into his hands? $60,000, the boot, right? Whatever the amount of the boot was, that was actually paid right into his hands. So whoever receives the boot, they will have to pay taxes, capital gains taxes on the boot. So it's not the full value of the exchange. So they don't owe taxes on the full $560,000. It's just whatever the boot was, okay? So that's how the 1031 exchange would work. Now this last law is just called a delayed exchange. Now, This works a little bit different than the 1031, but it pretty much accomplishes the same thing. But y'all again must have an intermediary, both for delayed exchange and the 1031. But my intentions under this exchange is I'm actually going to sell this investment property that I own. I'm actually going to sell it. I'm not going to just exchange it. I'm selling it. But I'm going to take all the proceeds from the sale and put it into another property that I'm going to purchase in its place. So I'm selling one property and I'm going to buy another one with the money I made out of that first sale. Now, obviously, whatever property you intend to purchase, y'all, the law says it must be a like property, and we'll define what that means here in a second. But it must be a like property of at least equal value or more. Why does that matter? Y'all, because you cannot keep 1 penny of proceeds from the first sale. Y'all, if any of that money touches your hands, if you ever take possession of that money, the deal's off, you now owe taxes on it. Y'all, which is one reason why you have to have the intermediary. So when you close, y'all, the attorney will send the proceeds to your intermediary, which will be held in a trust account, and you keep your hands off of it. Because again, if you ever touch any of that money, even 1 penny of it, deal's off, you now owe taxes on the whole thing. So y'all, every penny from that sale has to go into the new property. So that's why the law says whatever you're buying must be of at least equal value or more. Now, what does it mean when it says a like property? Y'all, a lot of people think it means, well, if you're selling a residential property, then you must purchase a residential property. Y'all, that's not how the IRS defines like property. The IRS defines it basically like property being in similar use. How do you use the property? So if the property I'm selling was a rental house, y'all, it's a residential rental property, but I had it rented out, y'all, so I'm using it for income producing purposes. As long as the property I'm buying is an income producing property, then that's considered a like property. Okay? So potentially I could sell a residential property and buy a commercial property, as long as they're both income producing properties. Y'all, that's what like means. But all right, so then it says, y'all, from the time you sell your house or property, you now have 45 days to locate a like property that you're going to purchase in its place. Y'all, hopefully you would already have the property that you're going to buy already identified when you go to sell it. But even if you don't, y'all, you got up to 45 days to find a like property. Y'all, if you don't do that, you owe taxes on that money. But then it says you have up to 180 days until you must close on that property, which is obviously 6 months. So that's a pretty good while there. But what I want to make sure you understand about these days, you don't get 45 days to find the property and then another 180 days to close. Y'all, that first 45 days is part of the 180 days you get in total. So from the time you sell your property, you got up to 180 days until you must close. All right. So y'all, that's how the delayed exchange works. Y'all, obviously, if I do that, no money ever touched my hands or came into my possession. So that kind of delays having to pay any capital gains tax. Y'all, don't have to pay any taxes on it, at least not at that time, because I never received any money to begin with. We just exchanged properties. So y'all, there's your delayed exchange. Y'all, hopefully all of that makes sense to you. It's not too hard, I don't think. But those are the real property tax laws that you need to understand.